Welcome to this weekly installment of the Whitaker-Myers Wealth Managers, What We Learned in the Markets This Week. My name is Summit Puri. I'm one of the co-chief investment officers here at Whitaker-Myers Wealth Managers. Thank you so much for tuning in. This week, as usual, we'll discuss 4 key focus points, highlighting key learnings from the market activities in the past week. In point number 1, we'll do a market recap with our key market indicators. In point number 2, we'll take a look at housing permits, housing starts, and the NAHB index, really taking a look at what's happening in the housing market. In point number 3, we'll talk about Federal Reserve Chair Jerome Powell's speech this past week and highlighting some key points from that meeting. And in point number 4, we'll talk about the U.S.-China tension and really some less discussed factors that you've probably not heard of in the market. So with that, let's hop right in. And now on to point number 1, the market recap. First, each week we review the Atlanta Fed seasonally adjusted GDP Now report to gauge in real time how fast our economy is growing. This week, the Atlanta GDP Now report shows a projected negative 2.2% growth as of April 17th, which is slightly up from last week's negative 2.4%. Next, each week we look at initial claims for unemployment insurance for a gauge into the front end of our labor market. This week, initial claims data fell by 4,000 claims, ending at 215,000, while continuing claims rose to 1.88 million. Next, we are watching mortgage rates closely to see how home affordability is trending. This week, we saw both the 30-year and 15-year mortgage rates jump up. The 30-year and 15-year mortgage rates ended at 6.83% and 6.03% respectively. And we'll talk more about the housing market later on in this video. Next, we'll look at investor sentiment. One component of investor sentiment is the bull-to-bear spread. The latest update shows the bull-to-bear spread fell slightly from negative 30.42% last week to negative 31.4% this week. Once again, investors are continuing to feel quite bearish with the current market. Another measure of investor sentiment is the VIX, or the volatility index. Generally, the VIX rises when stocks fall and declines when stocks rises, often showing an inverse price to action relationship to the S&P 500. And we've seen this in real time with the market volatility over the past week. Remember, the VIX value above 30 are typically linked to large volatility resulting from increased uncertainty and fear, while values below 20 generally correspond to a stable market period. This week, the VIX ended at 29.65. What I think is really interesting here is the VIX also provides a buy signal in many ways to the stock market. Now, we hit that quote-unquote buy signal earlier in the week, and we saw some market activity because of that, but there were many other factors that came into play this week, and we'll talk about those later in the video. Next, we'll continue to update you all on the Fed rate cut probabilities based on future contracts. Currently, the CME Fed Watch tool is calculating a 13.2% probability of a 0.25% decrease and an 86.8% probability of no decrease in May. Now, this is a big change from last week. Last week, the markets were predicting a 0.25% decrease by nearly 40%, and this week it's only 13%. Now, we'll talk a lot more about that later on in the video. And finally, let's take a look at how the markets ended. Last week, the S&P 500, which is our proxy for growth and growth in income, but only when considered together, ended negative 1.49%. The Russell 2000, which tracks small and mid-sized companies or aggressive growth in our Dave Ramsey vernacular, was positive 1.11%. And the MSCI EAFE, which tracks international stocks of developed countries across the globe, excluding the US, was positive 4.34%. Now, the biggest mover this week was international stocks, and real winner. Remember, we watch these market and sector fluctuations weekly to show you in near real time not only how the markets are performing, but the importance of diversification. Nearly every week we have a new leader. Appropriate diversification decreases your risk while exposing you to the upside. If you'd like an unbiased review of your portfolio, don't hesitate to connect with one of our advisors today. Now on to point number 2, housing starts data, building permits data, and the NAHB index. In March of 2025, building permits ended at a seasonally adjusted annual rate of 1.48 million units, showing a slight increase of 1.6% from the revised February rate. Single-family permits in March were down by 2% from February. Single-family starts in March ended down by 14.2% as compared to last month. From permits to housing completions, we saw overall housing completions in March 2025 fall by 2.1% as compared to March of 2024. Single-family housing completions in March saw a slight increase of 0.9% from February. Now, the NAHB, or Wells Fargo Housing Market Index, now that's a mouthful, or the HMI, which gauges builder sentiment in the single-family housing market, was 40. This is a slight increase of 1 point from March. This indicates that a majority of builders still do not feel confident about the current and near-term outlook for housing, as the reading is below 50. The components of the HMI showed mixed results. Current sales conditions rose 2 points to 45. Sales expectations for the next 6 months fell by 4 points to 43. And traffic of prospective buyers increased by 1 point to 25. Additionally, 29% of builders reported cutting home prices in April, unchanged from March, which with the average price reduction remaining at 5%. The use of sales incentives increased to 61% in April from 59% in March. On to point number 3, the Federal Reserve Chair Jerome Powell's speech this past week. Federal Reserve Chair Jerome Powell stated on April 16, 2025, that the economic growth appeared to be slowing. He acknowledged that a potentially challenging situation with President Trump's tariffs could push inflation higher while simultaneously weakening growth and employment. Powell noted that these tariffs were quote-unquote significantly larger than anticipated by the Fed, leading to quote-unquote fundamental changes in policy without clear historical parallels. Consequently, he anticipated quote-unquote higher inflation and slower growth as likely economic effects. In response to this uncertainty, Powell indicated that the Federal Reserve is in a wait-and-see mode and can afford to wait for greater clarity before considering any adjustments to its policy stance. He stated that financial markets, despite recent volatility, were orderly and functioning just about as what you would expect, and explicitly denied the existence of a quote-unquote Fed put to intervene if markets plummeted. Following Powell's remarks, Wall Street experienced further losses, and Treasury yields and the dollar also declined. This market reaction reflected investors' concerns about a quote-unquote trade war reality check, which was delivered by Powell. While Powell emphasized the need for patience, differing opinions exist within the Federal Reserve regarding the appropriate response to tariffs. Some officials, like Fed Governor Christopher Waller, believe that the inflationary impact of tariffs will be temporary, but still acknowledge that they could weigh on the economy and potentially cause a recession. Waller suggested that he would support interest rate cuts sooner and more significantly if the economy slowed sharply, even with elevated inflation. Conversely, other Fed officials are more focused on combating the inflationary effects of tariffs and may be less inclined to support the rate cuts quickly. Recent data suggests that the economy was in solid shape, with solid hiring and cooled inflation in March, but declining consumer and business confidence raised concerns about future spending and investment. Now on to point number 4, U.S.-China relations. Trade tensions between the United States and China have escalated in recent weeks, both countries implementing unprecedented tariff increases. For the moment, the U.S. has raised tariffs on Chinese goods to 145%, while China has countered with 125% on American products. The situation is evolving quickly and continues to affect financial markets. While global tensions can create uncertainty, history shows that markets have weathered challenges in the past. Despite the headlines, understanding the economic relationship between these two countries can help long-term investors remain and maintain perspective. While much attention has focused on the U.S. response to trade tensions, China faces its own economic challenges. These include persistent concern of a real estate bubble and a financial system instability that could impact its ability to withstand trade tensions. China's post-pandemic recovery has been uneven, with GDP growth slowing to 5.4% year over year in late 2024, according to the official Chinese government statistics. Many economists have already reduced their 2025 growth forecast below the government's 5% target. Some investors also worry that China's holdings of U.S. Treasury securities gives them undue influence over the U.S. economy. There have been concerns that recent moves in the bond market are a result of countries like China selling their U.S. Treasuries. While this is difficult to verify, what's clear is that China's Treasury holdings represent about 2.1% of the U.S. government's debt, according to government data. More importantly, most Treasury securities are still held domestically by U.S. individuals, corporations, and other federal, state, and local government entities. If China were to significantly reduce its Treasury holdings, it could potentially cause short-term market volatility and temporarily push up the U.S. interest rates. However, China and other countries hold U.S. Treasuries, the dollar, and other foreign assets for an important reason, and this is to maintain financial stability. The US dollar and Treasury securities have consistently maintained their quote-unquote safe haven status even during periods of uncertainty. This has been true over the past few years despite inflation fears, budget crises, US debt downgrades, and much more. Now, while escalating US-China trade tensions create uncertainty, history shows us that financial markets are resilient in the long run. A diversified portfolio aligned with your long-term financial goals remains the best approach to navigating the changing and challenging global landscape. And that, friends, concludes our discussion for this week. Thank you once again for tuning in. If you find this information helpful and informative, please take a moment to hit that like button below. By hitting that like button, you help push our content out to other viewers and listeners across all of our social media outlets. If you'd like to see our latest videos on your feed, including new content released by our team, please make sure to subscribe below. And if you'd like to meet with any of our financial coaches or advisors, please click on the link in the description below to schedule a meeting. Thank you once again for watching. We look forward to seeing you next week.